Hello, welcome to another edition of Nucleus Investment Insights. Today we are talking about the effects on earnings of the policy chaos we've seen. So, as we've spoken about several times in recent weeks, we've sort of sold down a reasonable chunk of stock in terms of at the start of the month, just with the view that there's some real damage being done. And so what I wanted to do is sort of dig into some of the numbers that we're seeing at the moment, because there's not heaps of signs of it. So it's still a sort of a faith-based or I guess an expectation-based view that we've taken. And we're watching pretty carefully what's going on in terms of both the stocks and the underlying numbers. And you're getting some differing messages depending upon where you're looking at each of these. So just a reminder, everything you hear today is general in nature. It's not personal financial advice. If you do want to have personal financial advice, you can book in for a call with us and we can speak about your scenario. Okay, so with that aside, I just want to jump into, I'm going to take a really quick aside as well before we get into that, just and talk a little bit about the tariffs. Then what I want to do is talk about some of the different indicators that you get and what that means and how much faith you can have in these indicators. I'll go through some of those in detail, like things like consumer confidence and then company earnings. And I've got that there's companies sort of report throughout the year. You get particularly US companies quarterly reporting. A lot of companies are on different balance dates, and so you do get this ongoing series of companies coming through, and you can get sort of head fakes from either one. But there's sort of a selection of companies that have come out just in the last week or two. That's quite a reasonable cross section of the economy in terms of things like cruise liners to retail stores and business services and stuff like that, which I think is quite indicative. And within those, you've got companies and management in particular being quizzed by analysts, and generally one of the first questions they're all being asked is, what are you seeing right now in terms of the numbers? So run through a few of those bigger US companies and just talk about the environment that we're seeing there at the moment. Right, so onto tariffs. So just quickly, so we've had the auto tariff announcements today. Next week there's going to be more announcements about reciprocal tariffs. So obviously, a key point. I guess the thing I just wanted to note in terms of tariffs is, in a way, I guess this is putting a little bit of a conspiracy hat on, and I just want to say, look, I spend a lot of my time debunking conspiracies. So this is sort of more of a, sometimes a simple answer is just that, this is just the way things worked out rather than there's a huge conspiracy about it. But if I was the CEO of an electric vehicle maker, say that and I just paid the US government, or just paid, a presidential candidate, hundreds of $millions of to get them into office. This is pretty much what I would have designed if I wanted to help out my company. So, arguably it's a bit of a Tesla protection screen. So first of all, in terms of saying, look, you need to be producing your cars within the US. Okay, so that's great for Tesla insofar as Tesla has factories all around the world, but what they do is they've got so two big factories within the US that produce almost all the US cars, and that's where the production comes from that. And then they've got their factories overseas, and China in particular, a little bit in Europe, but China in particular, that produces cars for most of the rest of the world. And so they're not going to be affected by this, although they're certainly going to be one of the least affected car companies by the tariffs because they do their production locally. So now they've put a bit of a dent in anyone sort of importing, and particularly some of the Chinese electric vehicle competitors who are really taking some really solid market share away from Tesla right around the world at the moment, and are really driving down costs. So now you've sort of erected a barrier wall for them, a tariff barrier wall. So that sort of helps them on that front. The second competitor, I guess, that Tesla has is your Detroit car manufacturers, so your other US car manufacturers. Now, the thing is with those guys is they're mostly, have quite North American-based supply chain. So they've taken advantage of the North American trade, NAFTA sort of trade, tariff-free policies that have been around for decades now. And so they've integrated their supply chains across Canada, Mexico, and the US. And so they're really going to suffer in terms of the car parts that just bouncing back and forth across it. So they're going to have to come up with different solutions for it. So in a way, you've sort of taken out most of your main competitors. Having said that, I do think Tesla's got a bit of a sales problem, but in terms of a cost problem and sales problem, I'm saying that their sales really seems to be falling relative to everyone else, largely based on it seems to be people's impressions of Musk. But from a cost perspective, they're certainly sitting a lot prettier today than any of their competitors, as far as I can see. And then the next step behind that says, okay, well, are you going to build a new factory in the US, particularly if that's a combustion engine factory in the US to compete with Musk? To compete with the tariffs and to put all your manufacturing within the US. Well, there's lots of problems with that. Now, you've got so much uncertainty around it. One is, well, will these tariffs be there in 3 or 4 years' time, or will we just have an expensive factory in the middle of the US that's no longer competitive on a global scale? Secondly, factories have got long production life in order to justify the building of the factory, the hiring of all these employees and all that type of stuff like that goes around it. If you're going to build a combustion engine, how much longer do you expect those factories to keep running for? And in particular, if even if you sort of assuming they won't go away forever in terms of combustion engines, they'll be around for quite a long time. Just the fact that electric vehicles are taking a bigger and bigger market share of these vehicles as time goes on. So that's one part. Another part is that from a combustion engine point of view, so you've basically now effectively added a premium into the cost of the sale cost of every combustion engine in the US. And one of the big things that really has been the problem with electric vehicles is the costs have been higher because the battery costs have been higher. And so now you're basically adding a tariff on everyone else except for Tesla. It's a positive for them. On the flip side, would you build a new electric vehicle factory in the US? Well, quite possibly, and especially because a lot of these are getting more and more automated. And also that the complexity of an electric vehicle factory is a lot lower than the complexity of a combustion engine. It is a lot more about putting together, sort of off-the-shelf components, so to speak, rather than what we're seeing, what you see in the combustion engine, which is a lot of different parts from a lot of different places, and just a significant factor of 10 times factor of more parts that go into it that sort of make it a lot more difficult. So yes. So anyway, so quick thoughts around tariffs is looks pretty good for Tesla, but it's bad for the US consumer in terms of they are going to have to be paying more for those cars. Okay, so that's a quick one on tariffs. So what are we seeing in terms of numbers? So you've got sort of 3 different sets of numbers that sort of come out in a broad sense. You've got what we call leading indicators, coincident indicators, and then the sort of lagging indicators. And from an economics point of view, you think about the leading indicators broadly as being surveys. What are you going to do? Asking people what are they going to do? The coincidence indicators tend to be things like spending at the moment, or credit card or sales data or foot traffic or something that you can actually sort of put on to saying, okay, here is things that we can see is genuinely happening. And part of the surveys are that as well, about asking, there's 2 parts to a lot of these, is to survey respondents. What are you expecting you to spend, say, for example, next quarter, and what did you spend last quarter, or whatever it is in terms of those numbers. And then finally, you have your the lagging data, and that's your profit and loss, or your GDP, or all these other figures that sort of go into it. And the quality of the 3 goes in that same order, in that your leading indicators can be very useful, and particularly at times like this, everyone's very ultra hyper focused on what's happening in the leading indicators, but they can also give the wrong signal a lot of times. And then you go to your coincident ones, and they, they're obviously time delayed, but give you a better indication of what's going on. And then, also that they can be thrown out. So for example, your sales numbers are going to be affected by the tariffs. So knowing, but you won't sort of know that, somebody's XYZ company has just sold a product and their sales are up, 6%. But is that just because they actually increased, all their costs increased by 10%? And so, the company's actually net doing worse out of it because of tariffs? Or is it a company, another company has increased their sales 6%, but it's actually not subject to tariffs. And so 6% are a real 6% that they're getting through. And so that type of data you don't get out until later on. You start seeing companies report and those sorts of things. But anyway, with that sort of in mind, what I wanted to just jump to was the conference board leading indicators. And I've got just a chart up sort of showing where that's going at the moment. So there's a coincident part of it and a leading indicator index, and the leading indicator has been going down for some time now. It's sort of years in terms of the fall. It's sort of leading indicators are below sort of pandemic lows, whereas the coincidence index is a lot stronger. So we've just had this real divergence between the leading indicator and the coincident indicator for months now. So that's one part of it. The next part is looking at the what sort of goes into these numbers. And so let me just pull that up on screen. So we've got, this is the one of the most commonly used one, the conference board indicators, and they've got sort of 10 components to go into it. They have a leading credit index, and that's sort of basically neutral in February. And it's been relatively positive for the last 6 months. They use the S&P 500 stock index. So now this is looking backwards at February. So you're missing out on the performance in March, but that's was positive there. So you can sort of mark in a negative one for that. They look at interest rate spreads. They look at consumer expectations, ISM new orders. So what companies are ordering, and so building permits, weekly hours, and then some different manufacturing orders, and then the jobs market. Now, largely, we're talking, particularly for March, if you sort of extrapolate forward from these, we're talking about some relatively negative numbers. So these are sort of suggesting there's at least problems on the way up, or certainly problems on the way forward. If you dig into that a little bit further, and we look at, say, the US confidence, consumer confidence, which was just out this week as well. So some pretty decent falls again. We've seen basically since the start of the year, we're now down to the range that we saw during the pandemic in terms of consumer confidence. So which is obviously poor, but if you look at the chart I'm showing as well, and I'll just, for anyone listening in just to the podcast, it's at levels sort of around about 90, and sort of during the pandemic, it was sort of between 85 and 95. But, post the financial crisis, it sort of fell to 40-ish, and or even closer to 20 at the worst of it. But it then sort of took 10 years to work its way back up to 100. So, probably from 2009 to 2015 before it got back up to 100. So certainly some negatives there, but and then when you dig within that, they also break it up into what people are thinking and what's actually happening. Now, this is a more interesting one for me, is that people's actual present situation is still fine on these numbers. The expectations are really bad, but actually the expectations have been like this a couple of times over the last sort of 4 or 5 years. So it's sort of this point about saying, well, everyone thinks things are going to be bad in the future, but things aren't bad right now. Consumers can get things wrong. So, but it's certainly a warning sign, but it's not it's not sort of any guarantee that we're about to head into some massive downturn. It is typical of what the types of things you'd see before you head into a downturn, but it's not. There's certainly no guarantees. And a note, I've got a chart that this same chart shows both the 2008 scenario during the financial crisis and then the pandemic. And you can notice the pandemic, the expectations was actually pretty decent right throughout. It was actually only the present situations that dropped. And within the 2008, it was really just this gradual ratcheting down over the course of about a year or so, where it fell from sort of 100 back to sort of those lower levels. And so, but it certainly did lead. The expectations did lead the end result for that. So, as I said, you can't read it either way, but it's certainly no guarantee that while things are bad. If you look at that from an expected point of view as well, sometimes you get these effects, particularly around elections, where it's just sort of different groups of people. And so some people might be doing really well and others poorly. But this is a bit of both, is that there's a lot more people expecting things to be worse and a lot more people and a lot fewer people expecting things to be better. So that's your consumer confidence sort of forward indicators. So they're not looking great. If you look at the purchasing managers indexes, and so what we're talking about here is there's surveys that go out to companies and they basically say, what do you think about either prices for the next year? What do you think about employment? How much capital expenditure are you going to do? There's a whole bunch of these series of questions, and it's often about, are you doing more or less than before? And so the magnitude can sometimes not sort of match up with real life events, but it does give you an indication of certainly the number of companies that are positive versus the ones that are negative. Now, we had a bit of a bounce back this week in terms of the numbers we're getting from the services. So this is, keeping in mind, this is split into two different parts, and this is just the US. Sorry, it's confusingly named. This is a survey done by S&P Global, but this is just the US services, and so that had a good bounce back this month, up to 54, and 50 is the line where you're talking about. 50 is a line where it's sort of going from positive to more people positive versus more people negative. Yeah. So sorry, that's that PMI. They do have various components of that. The other thing that bounced back was the employment side of that. So that was sort of quite a positive for this month at least. So that's on the services side, and that's keeping in mind that that's much less likely to be affected by tariffs. On the manufacturing side, it's certainly negative, but it's been stronger than expected recently, and this is and it's it's basically, when I say negative, it's 49.8, whereas 50 is your dividing line. So the services is certainly a poorer month this month, but it's not in sort of any dire territory. And then the other part of that is the employment, though, was probably one where you did have a big drop over the month. And so, yeah, just, I guess, one worth watching, but it's not sort of, it's not panic stations as yet. Okay, so that's our PMIs. Sorry, the other one of interest on the manufacturing side is, if you look at the prices side of the PMI, and this is the manufacturing PMI, that's had a couple of really big jumps in the last few months, and this is talking about input prices. Now, the tariffs are only just hitting, so this potentially could go a lot higher, and that's where I guess inflation concerns are really starting to rear their heads. Right, I might go to a quick message, and then we'll come back with some more of these leading indicators.
We'll be back with the investment insights very shortly. Nucleus Wealth is an active and passive investment manager. If you like what you're hearing and want some help with your investing, we can do it for you via our active portfolios. Our tactical and core portfolios use the insights shared in this podcast to construct and manage your investment. We blend tactical portfolios to offer our combinations of international shares, Australian shares, government bonds, and cash. We vary the asset allocation with the goal of protecting your capital in times of market uncertainty. We also have active international and Australian share portfolios. These are chosen using our quality and value investment philosophy. You can find out more at nucleuswealth.com. Now back to the show.
Right, so just onto some consumption data as well. That we had some data out from Moody's, and I just wanted to highlight, I guess, in terms of when we're talking this consumption data, is that the US has sort of really changed from 20 years ago, where the middle class, of income made up most of the spending, to where now the US personal spending is 50% is the top 10% of consumers there. So there is a certain element to the US which is much more around what matters is the richest part of the economy, and not on a stock by stock basis. Obviously, there's stocks that sort of cater to each part, but at broad macro stats, really just want to highlight that the top 10% are now 50% of the US economy by personal spending. Whereas if you go back 20 years, the top 10% is that, and the 60 to 90% percentile in terms of income brackets now only makes up 30% of the spending. Whereas you go back 20 odd years, and the 60 to 90% was actually the largest component of US spending. Okay, so that's just with that in mind. I wanted to jump onto just a few of the other stats we're seeing around. A few of the other stats we've been seeing around that I think are relevant. The housing market. So we're talking about some quite high numbers of unsold inventories. So this is I've got a chart up just sort of showing the numbers of unfinished houses, and obviously we went through this massive housing boom in 2006 to 2011, so that sort of got up to 190 odd thousand houses. Prior to that, it was sort of around about the 80,000 level, and for most of the decade after the housing crisis, it was sort of more in the 40 to 80,000 level. And in the pandemic, that sort of fell to 30,000, and then now it's just sort of rocketed up from there, and it's approaching 120,000 at the moment. It's certainly an area for concern in terms of US. So that's one area we're looking at. But truth be told, that's also one of the parts which is most interest rate sensitive, and that's one of the things that the Trump administration is explicitly targeting, is trying to get interest rates down and the long-term rates. And so arguably you start knocking off 0.5%, 1% of interest rates, then that's really going to make a difference to that part of the market. The other thing is we've seen a bit of data coming out on the when I get back to companies, and I'm particularly talking about capital expenditure here and signs, is data centers. And because that's one area, we've sort of had the view within our portfolio that, look, some of the manufacturing capital expenditure we're probably going to see a big hole in, but the data center is going to hold up. So let me pull up that chart. So I've got a chart just showing from Pantheon, just sort of showing that from some of the surveys about future capex intentions and software in particular, and that's sort of certainly taken a bit of a jump up in terms of what the expectations are there, and so that's sort of suggesting that there is going to be continued software investment on that front. I think also though within that I would note that Microsoft has certainly been pulling back in terms of its data centers, and that's where I guess some of the concerns, particularly around NVIDIA, have sort of popped up. But at the same time, both Meta and Google have actually been increasing the amount of work they've been doing in their data centers. So it would seem at the moment that seems to be more like a Microsoft's already got capacity and it doesn't need that extra capacity, whereas Google and Meta are both needing more capacity. More of a market share issue rather than concern about that whole sector coming back. But yeah, so certainly on that front, I'm sort of there's been sort of encouraging information that we're not seeing any sort of major downturn in terms of that CapEx side. So that leads us on to earnings, and that's probably the most important part of this. So if we look at earnings, and I just sort of look back, I'm looking at the second quarter earnings for companies within the US, around the world. And a month ago, we were looking at about a 6.5% return, and we're still looking at about a 6.5% earnings growth. So really haven't seen too much. Compositionally, that sort of big tech really hasn't changed. It actually has been a bit weak in the US, but that's been offset by a little bit of strength around the rest of the world, particularly sort of non-Eurozone Europe has picked up. And so, again, in terms of the earnings front, I've looked at it a whole bunch of different ways on the earnings side, and actually neglected to put the other chart in that I wanted to sort of show in terms of the what's happening in terms of the earnings across it. We are seeing some steady downgrades generally to 2020 to the 2025 numbers, but they're relatively minor and more typical to what you'd see in any cycle. In a normal cycle, you typically get analyst forecasts, and then you get some gradual downgrades, and they knock 1 or 2% off, and that's where you end up at the end of the year. And that so far that really looks typical to what we're seeing. And talking about the individual companies, though, that's probably the part that is most interesting. So I grabbed a set of companies that have been making announcements, have reported earnings announcements and had conference calls just in the last sort of 2 weeks or so. And it's pretty decent set. So we've got Carnival Corp, which runs cruises. So, it's a very discretionary spend going on holidays. Darden Restaurants, that runs sort of chain restaurants and targeted towards sort of the middle class and cheaper end of restaurants. Dollar Tree, which is like a reject shop. It's a discount retailer. Centres Corporation, which is a lot of services for companies, particularly a lot of things like uniforms and stuff like that. And then Paychex, which I've got a little bit extra there. But you run through them. Carnival Corp, big upgrades. They're talking it up. They've got increase in their forecast. So really quite a positive result from them. Darden Restaurants, really just talking about no real changes, solid result, demand holding up to the moment. Similar for Dollar Tree, and I guess Dollar Tree is probably one of those areas where, given they sort of that discount retail, sometimes what you see when people run into problems and have consumer confidence issues is that actually some of the discount retailers might actually pick up service. So people steer away from the brand names. Yes, I need a new shirt. I might have otherwise gone and spent a lot of money buying one from a name fashion brand, but I'll go and buy one from a cheaper store or that type of thing. And so they're talking about, they're actually expecting margins to increase despite tariffs, and particularly a lot of their products come from China. So they're expecting. I guess reading between the lines, it sounded basically as if they've been working on their supply chains from other countries, and they're expecting to be able to stick their prices up because they've got an excuse now because of tariffs, but their costs won't actually move anywhere near what the prices will move. Centres Corporation, as again, they're a service corporation. Really strong growth, no changes from customers. They're talking about that. And the questions that are being asked are quite targeted around, the latest stuff, and they're basically saying no. They're seeing what they're seeing. And Paychex, I've actually got a quote from them just because I thought it was quite telling. So what Paychex do is they provide employment services for the US. Now, I do want to note that employment is usually one of the last things to start falling. when you run into these problems. But there are you can stop hiring new people, and that's these guys certainly get data about that type of factor. And so, the question was a much longer-winded question, but effectively it was anything different you're seeing in terms of demand environment in the past few weeks. And he's basically saying, no, look, on the personal employment side, their bookings are double digits. They've got a good pipeline going into Q4. So the underlying demand, they think, is good. They think demand's remaining at historic levels. They thought Q3 was a little softer than last year, but that they think that's still going well. And then the question what they're really honing in on and saying is that, look, from a hiring perspective, when they're looking at data from out of businesses and looking at data from their clients, adding additional sites, they're up sort of double digits, so 10% plus. And that they're just saying these are not indicators of a pending recession or macro employment problems. So this might be that companies are just, look, you're already committed to opening a new store, you're already committed to opening a new branch in a different place, and so you're not going to change, just in the last sort of 3 weeks based on what you're hearing out of Trump. But so I don't think this is an indicator that things are, it's not necessarily an indicator that things are going to be great and it's all fine, but there's certainly no signs within what companies are saying, or very few signs within what companies are saying, that we're really running into any problems as of yet. Now, I've got a lot more thoughts about this I want to run through, but let me just go to one more message first.
We'll be back again shortly. If you like what you're hearing but want a low-cost passive option, Nucleus Wealth is the first to offer passive direct indexing in Australia. The first generation of passive investing was index funds. The next gen was ETFs. Now, direct indexing is here with significantly more customization and control. The benefit of direct indexing is you can add or subtract investment themes, and we have almost 100 different options to choose from. For example, you could buy an international share direct index portfolio that excludes fossil fuels and arms manufacturers and has a tilt towards cybersecurity and cloud computing. Alternatively, you could buy a portfolio with no screens and an extra exposure to nuclear power and defense contractors. You can find out more at nucleuswealth.com. Now back to the show.
Yes, I'm going to split this into sort of 3 parts for discussion. So the concerns around the US growth in particular. There's a number of different elements to it. The key element is capital expenditure, and are you going to see some big falls in capital expenditure? Now, we've certainly seen very few signs of that to date. There's some confidence stuff around that. There's some survey data around that. I guess the one mitigating factor around that, is, look, 3 weeks is not very long. Most CapEx projects have very long planning stages. If you've already planned, if you'd already decided to do this a month ago, 2 months ago, 3 months ago, are you going to cancel it? I think in some cases where there's sort of direct tariff implications and lots of uncertainty, that you're going to get cancellations, but it does not seem to be widespread as of yet. So that's the CapEx side. Not to say that this won't continue. If you're having a whole bunch of people now making decisions and saying, no, look, we're not going to do this. That sort of very early leading stuff, we could still certainly wouldn't be out of the ordinary to see that coming out over the next 2 or 3 months. But there's really not a lot of signs at the moment. So that's the CapEx side. There's the consumer side as well. Then, so on the consumer side, really not a lot of signs. There's been a couple of smaller companies you can point to, but it's quite possible they're making excuses as well for a poorer sales performance. The question is, when will consumers start being affected? Well, chances are these price rises are what's going to start causing the problems on the consumers. The consumer confidence numbers are really down, but the current status of consumers is still quite positive in terms of where they sit. So not to say that it's not going to happen. It's just that it certainly hasn't happened yet in terms of a consumer downturn. Consumers themselves are expecting it, but they've actually been expecting relatively poor conditions for the last 3 or 4 years and kept spending throughout. So so again, it's sort of not, that's not part. And the other part then is just geographically, it does look as if Europe is starting to go through a bit of a positive performance part, and earnings seem to be picking up there. We saw, last week some things passed the German Parliament in terms of lots of spending initiatives. There's net. We've put a pull back. If we had now been seeing lots more signs that, and we start, and this could still happen, if we start seeing more signs of going into genuine downturn, that's where we'll keep sort of removing stocks from our portfolio and bringing back those weights back. We do have a reasonable amount of cash. If we start going through, months of this and just not seeing any signs at the fundamental levels, we'll be sort of plowing that cash back in, at lower prices. But the big picture sense for me is, look, I am still concerned about the outlook within the US. I am concerned about a growth hole. At some point, Trump's going to flip and start throwing money at the problem and trying to get the economy going. But that does not seem to be right now, and it could be 12 or 18 months away before they get there. The explicit plan from Bessent is really to bring back demand, particularly government demand, bring down inflation, bring down interest rates, and sort of hand over back to get rid of regulations and hand over the economy back to the private sector. It's fine as a plan. The issue is mostly in the execution, and there's not Trump's picks are not filling us with confidence around their ability to do the execution, and so there's certainly concerns around that. But then the second concern is, is there a big enough growth hole that markets really do suffer? I still think that's more likely than not likely, but I just really do want to highlight that what we're hearing from companies, what we're seeing in the data, the consumer confidence data, is it's negative, but it's nowhere near sort of major downturn and recessionary levels as of yet. So a bunch of different questions we've had around from people. How long does it usually take for real world weakness in sales to flow through to analyst forecasts? It does vary, and there's lots of companies that will, depending upon how far back from the consumer they genuinely are, or back from the affected, it can often take 6 or 12 months for some of these companies to really even notice what's going on, because of back orders. If you're building things that just have these long lead times, you can have consumers sort of come to pretty much a stop, and some companies just not notice for a long time because they've got long-term contracts, or it's building, and the building keeps going, but there's no new projects once you finish that type of stuff. So there's that one. The thoughts around resources and how they're going to be affected. Look, resources are one of those factors that are right on the end of this scale. So, the consumer starts to slow down. They stop buying things. The people that then, that next level then, place fewer orders, and the next level place fewer orders back to the manufacturers, and the manufacturers who need then to get the sort of various, copper and stuff like that goes into, say, a washing machine. They start cancelling their orders. That takes a long time, that whole process. You're talking months of those. So resources are certainly going to be one of the more lagged experiences there. How are global markets reacting compared to the US? We're certainly seeing, these are questions from QDBB6. Global markets, the earnings are we've been seeing upgrades, particularly in Europe. So not to say that, that if you do see a big US downturn, Europe will be affected as well, that flow-on effect. And that's of weaker demand from basically the world's biggest demand source will affect them. But at the moment, it's that's been the case. What's my take on Tesla's future? Look, the issue with Tesla is if they are successful on the self-driving front, I do think there's going to be a lot fewer cars. So it's almost a bit of a, the people who are saying, look, buy this because Tesla's going to be the most successful on driverless cars, and so therefore they're going to be the winner. Is that it's a little bit of a poison chalice, that one. I could easily see a case where driverless cars are successful and the amount of car production falls by 80% globally. When you look at the sales, Tesla certainly put itself in a the strategy of backing Trump and getting a lot of control over US policies seems to have been pretty good from a cost perspective. The issue is it good from a demand perspective? That seems to be where the real issue is. If you're of the view that Tesla demand is going to come roaring back at some point of time, then it's, you might have a buy case, but that's about the only reason I can see to be wanting to it. Its valuation is just dramatically different to any other car company. Almost any other car company you can pick up for a single digit earnings almost definitely, and a lot of them low single digit, sort of 4 to 6 times earnings. Whereas Tesla, you're paying whatever 90, 100 times earnings, like probably 20 times the amount. So Tesla is one for the believers. It's not one for somebody, or you've either got to be a believer or just have an extreme view on how much growth they're going to get. Whereas that's not us. Excellent. Anyway, so thanks everyone for all the questions today and for tuning in. We are on every Thursday, 12:30. Smash that like and the subscribe button. Feel free to drop in any comments, or you can obviously do that live, and we can answer them as we go, or pop them in the comment section, and we'll have a go at your thoughts afterwards. Especially if you've got any thoughts around things you would like us to cover. Thanks everyone, and we'll see everyone next week.